5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this latest episode of the Follow the Money podcast, episode number 484. We have entitled today's episode, 4 Financial Lies That Americans Believe. My name is Jerry Robinson. As always, it's great to have you along for the ride. Well, April is Financial Literacy Month, and in honor of that, I thought we would tackle some of the biggest financial lies that Americans believe. These are lies that can rob you of peace and stability and a secure future. And, you know, I've seen lots of things over the years. I've certainly helped many people on their path to financial freedom. And I got to say, these aren't the only lies that are out there, but these are 4 biggies. I mean, these are ones that are problematic. So we're going to dive deep in this episode into these myths, and we're going to break them down and unpack some of their hidden dangers. And then, most importantly, I'm going to equip you with smarter strategies to navigate around them. So with all that said, let's dive into financial lie number 1. Let's get started. All right, financial lie number 1 is, I only need one income stream. You've heard that before, right? You go to school, you get a good job, you work hard, and you retire with dignity, get the Rolex watch, well, maybe a Timex. Sounds pretty straightforward, doesn't it? But if there's anything that we've learned over the last several decades, especially with the economic shocks that we all saw in 2008, 2020, 2022, and even now in 2025, is that relying on a single income stream is one of the riskiest things that you can do with your financial life. You think of your income like a stool. If that stool has one leg, it doesn't take much, a job loss, an economic downturn, a health crisis, to send you crashing to the ground, right? But now imagine that you have a stool with 3 or 4 sturdy legs. Well, if one of them breaks, the others are going to hold you up. Now, what we're talking about here is not simply just picking up a second job or side hustle, though those can certainly help. What I'm talking about is strategically building diverse sources of income that work for you, whether you're awake or asleep. I'm talking about passive income streams, investments that pay dividends or interest, real estate income, and even tax-free income streams. Now, this has been a passion of mine for many, many years. For those of you who've read our book, Bankruptcy of Our Nation, there's a whole chapter devoted to 20 plus different income streams that you can create both now and in retirement. And even here for our members at followthemoney.com, we have that income university that allows people to go through and learn different income streams that they can create. And what I love about the topic of income streams is that there are so many different ways to approach it. You know, there's tax liens, there's rental real estate, there's trading. And, you know, many people have never even considered that things like life insurance, specifically properly structured indexed universal life insurance, can be one of the most powerful and often overlooked income streams, tax-free. And I'm talking about life insurance. You know, a lot of folks hear that and immediately tune out. They think, well, it's about death benefits. But that's another lie we've been told, right? A properly designed indexed universal life insurance policy can provide a strong death benefit, yes, but it also offers something incredibly valuable in terms of living benefits. And these are the benefits that you can tap into while you're still alive. And over the years, we've seen many of our members develop new income streams, you know, just like we've talked about rental real estate or starting their own business or even using permanent life insurance to create a tax-free source of income as needed. I mean, just imagine having a pool of cash that grows on a tax-deferred basis that's linked to market returns, but shielded from downturns by a floor of protection. And then when you're ready, you can access that money, potentially tax-free, as supplemental retirement income or as funding for other life goals. I mean, that's very powerful. right? But many Americans are locked into believing that they just need one income stream, usually from their job or perhaps a single retirement account. But your financial security depends heavily upon your ability to build multiple, diversified streams of income that support you no matter what life throws your way. And, it really requires us to think outside the box because we don't learn this in school. And if our parents don't have multiple streams of income, then we're probably not going to think about it that way, right? But that's something we've been teaching here for many, many years. Let me drive this home with a quick example. I met a gentleman several years back. He was a successful software engineer at a major multinational corporation. He was high up in the management team. He had a solid six-figure salary, but he was completely dependent upon that one income source. And he had found our podcast. He read our book. He started reaching out to us. And right about the time he reached out to us, of course, he believed that his job was secure, but he walked in one day to his job to find out they were downsizing. And just like that, his stable stool with just that one leg fell apart. And so there was stress, there was anxiety, there was a scramble to replace that income. And I remember helping this gentleman, really kind of figure out how to diversify his income streams. He had a great education. He had a great background. And in his mind, he was just simply looking for that next income stream to replace the one that he had had. Well, slowly but surely, he came to realize that he could actually create multiple streams of income. And now today, that gentleman is running a few businesses and actually has doing quite great. In fact, he's doing better than he used to, even with that solid six-figure salary that he used to have. Now, if you contrast this with another family I've worked with who embraced the idea of diversified income streams early on, they had their primary jobs, but they also built passive income through real estate. We helped them in terms of the life insurance. We helped them with an index universal life insurance policy that created tax-free supplemental income when they retired. They also set up some dividend-paying investments. They also looked into creating a side hustle. And so when the storms of life came, as they always do, this couple wasn't anxious. They were steady, they were confident, they were secure. And so we all kind of learn this either the easy way or the hard way, right? That one income stream is simply not enough. True financial peace and security comes when you embrace income diversification. It's so often talked about. We hear about the need to diversify our investments, or we need to diversify our approach in our stock portfolio or whatever. But, again, income diversification is wildly overlooked. And it's not just using stocks, it's not just using bonds, but you need thoughtful strategies that help you diversify your overall income to protect you from the inevitable difficulties of life. For all of our members here at followthemoney.com, I encourage you to check out our Income University. If this is resonating with you, hop on to our website and go to followthemoney.com/incomeu, and it will take you through the 20 plus different income streams that you can create both now and in retirement. I really encourage you to do it. It's something that you can set up. It takes time, of course. You're not just going to go out and create multiple streams of income overnight. But if you make it a goal, it's something that you can really achieve. And we're here to help all along the way. Okay, so there's financial lie number one. All you need is just one income stream. Boy, is that a lie. Let's move into financial lie number two. And this one's a big one. And you've probably heard it said many different times over the years. And it often comes from well-meaning financial advisors when they say this. Here's the lie. Buy term and invest the difference. Now, I'm going to be upfront and I'm going to be crystal clear. I am a big fan of term life insurance. I own term life insurance on myself. I recommend it regularly. And frankly, if you have someone depending upon your income, I think it's an absolute must. But here is the catch, and it's crucial. It's the misuse and misunderstanding of this concept that concerns me. You see, the problem isn't with term insurance itself. Term life insurance is affordable, it's straightforward, it gives families peace of mind, it provides that critical protection when they need it most. But it's especially effective when it's convertible term insurance, meaning that you lock in your insurability today while you're still healthy, and then you have the guaranteed option to convert some or even all of that term policy in the future into a permanent life insurance policy. Now, that's a fantastic feature and one that I strongly encourage. But here's where the lie creeps in. Far too many people hear buy term and invest the difference, and they take it as gospel truth without actually thinking it through. So let's first break it down very clearly. This advice assumes two very important things. Number one, that you're actually going to follow through and invest the difference diligently, consistently, and wisely. Right? And number two, that your investment returns will consistently meet or exceed expectations over your lifetime. And as someone who's been helping people with their finances, and particularly their life insurance, for the last 16 or 17 years, I can tell you that most people don't actually follow through with the second part. That is the invest the difference part. Instead, what often happens is they'll buy the cheap or inexpensive term insurance, which is great. The fact that they have insurance is excellent, but they never properly invest the difference. So they spend it on day-to-day expenses, or they simply let it slip away. Next thing you know, the decades pass and the term policy expires, and they're left older and possibly less healthy, often less healthy, and in many cases uninsurable or facing dramatically higher premiums. And this is why it's so important, because life insurance isn't just about today, it's about tomorrow. So term life insurance policies typically last, 10, 20, maybe 30 years. But when the policy expires, then what? Without converting to a permanent life insurance policy or having diligently invested the difference, you can be left completely exposed, facing a financial future without proper protection at precisely the age when you may need it most. I'll just give you a realistic picture here. Imagine somebody who follows the buy term and invest the difference advice. They buy the cheap term policy, but didn't diligently invest. Maybe they saved a bit here, maybe they saved a bit there. But life happens. They got medical bills and college tuition, and the kids need new shoes, and they need things for school. And then, of course, you got home repairs and auto repairs. And so they never actually built the wealth they intended to build with that buy now and invest a different strategy. So now, decades later, their term policy has run its course and they no longer have any kind of life insurance. And meanwhile, the permanent insurance is either extremely expensive or no longer even an option. And this leaves them financially vulnerable at exactly the wrong time. Just contrast that with many of our clients who purchase convertible term insurance, and early on, while they're still young and healthy, they secure that insurability. They lock in the insurability, and they make sure that it's convertible. That way they can convert this to permanent life insurance at any point down the road. There's a few different types of permanent insurance, but one of the most common is the Index Universal Life policy, which I really like. There's also whole life insurance, which is very powerful. But both of them are permanent. They're cash value policies, and they provide lifelong coverage and accumulate cash that the person can then access down the road, typically tax-free. And that's what's so powerful about a properly structured permanent life insurance policy, is that you're not just protecting your loved ones, though that obviously is important and vital, but you're also building a tax-efficient savings vehicle, one that can provide you with tax-free income down the road if it's structured properly. I mean, I've seen it time and again with our clients who end up with lifetime coverage, peace of mind, and a powerful source of retirement income that doesn't depend upon the volatile markets out there. So let me stress this again clearly, because I know there's a lot of life insurance agents who listen to our broadcasts, and I want you to know that I believe that term life insurance is absolutely important, and many people need more of it, quite frankly. In fact, most Americans are underinsured when it comes to life insurance, and I frequently recommend that families buy plenty of term insurance. So the problem is not term itself, right? It's the lie that term is the only type of insurance that you should ever consider. It's the rigid, misguided belief that term insurance is always sufficient in every case, and that permanent insurance has no place, or that the difference saved in premium always magically ends up invested wisely over the long run. So what's the real truth here? Well, the real truth is that permanent insurance is not for everybody, but it's absolutely right for some. And the smartest approach for most families is likely a blended approach, where you buy some affordable term insurance to meet your immediate needs, with the option to convert some of that or all of that term coverage into a permanent policy later on. In my opinion, that combination of term plus permanent insurance often provides the ideal balance of affordability and flexibility and protection, but also wealth accumulation. So friends, don't fall for simplistic slogans when it comes to your financial future. Don't get caught believing the myth that permanent insurance never makes sense. You got to keep your options open. You got to use convertible term insurance wisely and make sure your long-term financial plan is genuinely diversified, not just in stocks and bonds, but also the way that you structure your life insurance as well. I've used this illustration so many times through the years, but if you had a home contractor come into your house and there was, he needed to nail some nails into the wall to do something, and he didn't have a hammer, and he started using a screwdriver, the end of a screwdriver, to hammer in the nails, and you ask the guy, what are you doing? Why aren't you using a hammer? He would say, oh, I never use hammers. Hammers are terrible, right? You would think to yourself the guy was a mental nut. He's a nutcase, right? Who in the world doesn't use a hammer on a nail, right? And why would you not use a hammer when it's the best tool for that particular problem? And that's exactly what we're talking about here. When you rule out an entire asset class and say, because you heard somebody say that it was bad, that you're not going to use it, that is not wisdom. Every financial product on the planet is a tool. It is a tool, and we don't always need a hammer, right? There are some times when we need a screwdriver. There are other times when we need a nut driver, but sometimes we do need a hammer. And so therefore, don't let anybody let you swear off an entire asset class just because they don't sell it or they don't like it. Well, every financial product is ultimately a tool, right? And it may be true that it's not right for you, but only you can decide that. I hope that makes sense. All right, well, coming up after this break, we're going to tackle financial lies number 3 and number 4. We've got more myths to bust and better strategies to discuss right here on the Follow the Money podcast. I'm Jerry Robinson, and I'll be right back.
Are you prepared for the next stock market crash? It's not too late to protect yourself and your family with Jerry Robinson's best-selling book, Bankruptcy of Our Nation, now in a new audiobook format. Whether you want to listen in the car, at the gym, or on your iPad, we've got you covered. Get the entire 300-page book in audio format for only $24.95. That's over 12 hours of Jerry Robinson's economic wisdom, financial insights, and practical money-making strategies for only $24.95. Inside this new audiobook, you'll learn 21 profitable income streams you can create both now and in retirement, along with unique tips on how to inflation-proof your investment portfolio using our own PACE philosophy, and our 5 levels of financial freedom, which is Jerry Robinson's personal blueprint for building true wealth. If your goal is to become a better investor, increase your income, or just understand what is really happening in the global economy, you cannot afford to miss out on the vital information that is jam-packed into this 12-hour audio book. Get instant access to Bankruptcy of Our Nation in audio format right now by going online to www.ftmdaily.com/bankruptcy. That's ftmdaily.com/bankruptcy. Download your copy today and get on the fast track to true wealth and a lifetime of financial security.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All All right, friends, welcome back to the Follow the Money podcast. I'm Jerry Robinson. You're listening to one of the longest running personal finance podcasts on the web. And today we're continuing our discussion on the 4 dangerous financial lies that far too many Americans believe. Now, let's get into a lie that can have devastating consequences, especially for those who are just retiring or nearing retirement. And that lie is this: I can rely upon historical market returns to carry me through retirement. There's the lie. Did you catch it? Let me say it again. I can rely upon historical market returns to carry me through retirement. Now, on the surface, this sounds pretty reasonable, doesn't it? I mean, after all, we've heard the standard pitch. The stock market averages around 7 or 8% annually over the long run, right? So naturally, many folks assume that if they just put their money in stocks and ride out the ups and downs, everything will eventually turn out fine. But here's the truth, and this is absolutely critical, is that timing matters more than you might think, especially in retirement. You see, when you're accumulating wealth, when you're in that wealth accumulation phase, market dips actually benefit you because you're buying more shares when prices are low. But once you retire, the game completely changes. You're no longer investing new money into the market usually. Instead, you're taking money out to live on, right? You're taking distributions. You're not making contributions anymore. And so if a major downturn hits early in your retirement, that's what we call sequence of returns risk. It's a risk that can absolutely devastate your financial future. Now, what exactly is sequence of returns risk? Maybe you've heard of it before. Well, it simply means the order or sequence in which you experience investment returns. So imagine 2 retirees with identical savings amounts, right? Both average the same annual returns, let's say 7% over a 20-year period. But if the first retiree experiences a severe market drop right at the beginning of their saving period, their accumulation period, and the second retiree encounters a similar drop later in retirement, even though both averaged the same return and started with the same amount, the first retiree's portfolio could be completely exhausted decades earlier, simply because of poor timing early in retirement. And this can actually happen at any point of your savings, right? So let me tell you, friends, right now in early 2025, we're witnessing exactly the kind of volatility that makes sequence of returns risk a real concern. I mean, the markets have been up and down like a roller coaster. We got interest rate uncertainties, we got tariff tensions, we got geopolitical risks. It's enough to make even seasoned investors a little uneasy. Now imagine someone who's just retired this year, fully relying upon their investments to provide monthly income. Well, that volatility is not just uncomfortable, it can permanently damage their financial future that they've worked so hard on. So what's the solution? How do you mitigate the risks created by sequence of returns that could be adverse? Well, the key is often with many things, diversification. But hear me carefully on this. Diversification doesn't mean just owning different types of stocks or mutual funds, right? Real diversification means holding a balanced mix across multiple asset classes, including assets that are not directly tied to the stock market performance. This is why you'll often hear me talk so often about a safe money bucket. Your financial life ideally should have 3 buckets. You need a liquid bucket. This is cash that you need now, like a now bucket, right? And then the investment bucket, which would be like stocks and bonds and real estate and cryptocurrencies, things that are longer term. And then crucially, you need a safe money bucket. And these are going to be safe money assets that are not subject to market volatility. They need to provide, some sort of predictable growth and stability and peace of mind that you need during turbulent markets. These things can be things like fixed annuities or properly structured permanent life insurance, like IUL, the Indexed Universal Life we were talking about earlier. It could be municipal bonds, which pay a tax-free income, as well as other assets. But the point is that a safe money bucket is absolutely vital to be able to help you weather the inevitable market turbulence that lies ahead. Now, many of you know that I'm personally invested in stocks. I think they're a powerful vehicle for long-term growth, but I would never put all my eggs in that one basket. Why? Well, because as wonderful as the stock market can be over very long periods of time, in the short run, especially when you retire, volatility is your enemy. So having a meaningful allocation to your safe money bucket can be the difference between retiring confidently and being forced to significantly cut back your lifestyle or even return to work later in retirement, which I've seen too many times, sadly. The sequence of return risk can happen at any point. Well, maybe I'll just illustrate a point here. Let's say that someone retires with all of their retirement savings in stocks, right? And the market drops 30% in their first year of retirement. Well, they still have to withdraw money to pay bills, right? And because they're pulling out money now during a downturn, they must sell their shares at a steep loss. Now, even if the markets bounce back strongly later, they still have fewer shares remaining to benefit from the recovery, and their portfolio shrinks faster than expected, potentially creating a financial catastrophe down the road. Now, contrast that with someone who has a balanced portfolio. They have some stocks, yes, but they also have significant assets in their safe money bucket as well. And so when markets tumble, instead of cashing out their stock investments, they can actually tap into their safe money assets instead. This allows them to ride out the volatility without selling a single share at a loss, right? And this simple but powerful strategy helps protect their retirement from the devastating effects of sequence of returns risk. Now, here's the truth behind the lie, by the way. Historical market returns are averages, not guarantees, right? So your retirement isn't determined by averages. It's determined by your actual experience, and timing matters tremendously. The sequence of returns that you receive each year on your retirement accounts is going to determine what you end up with in that retirement bucket of money at retirement. So my advice to you is to not put all your retirement dreams entirely in the hands of market volatility, right? You want to diversify wisely. You want to allocate money to your investment bucket. Sure, take some risk, buy some stocks, buy some cryptocurrency, buy some real estate, right? But also allocate money to your safe money bucket so that you ensure that market swings don't derail your plans and force you to cash out of your investments at a very inopportune time. So financial lie number 3, which tells us that we can rely upon historical market returns to get through retirement, is just straight up a lie, right? We really need to have diversification to protect us from that sequence of returns risk. Now, let's move into our 4th and final financial lie. And this one, I have to say, really hits home for a lot of families. The lie goes something like this: legacy and estate planning are only for the wealthy. You ever thought that, or you ever heard that before? You ever found yourself thinking that estate planning is something reserved for the ultra-rich, the millionaires, the people with sprawling mansions and complex investments? Well, let me tell you straight up, this couldn't be further from the truth. In fact, it's one of the most dangerous financial misconceptions out there, and it can often leave families in heartbreaking situations when the unexpected happens. Listen, I've talked to far too many families over the years who believed this lie. They didn't consider themselves wealthy, so they never made an estate plan. They never set up life insurance. They never established clear instructions for their loved ones as to what to do when they passed away. Many of them never set up wills or took advantage of living trusts. Many of them end up in a hospital, and their loved ones have to make healthcare decisions for them because they didn't make healthcare decisions for themselves while they were still alive. And so when tragedy struck, it was far more devastating financially and emotionally than it had to be. Right? Here's the reality, that estate planning is not just for the wealthy. It's about anyone who wants to make sure their wishes are honored and that their loved ones are protected after they're gone. Many people don't see it this way, but every single person that you know, everyone has an estate. Yes, even you. Whether you have $50,000 or $5 million, estate planning matters because your family matters. I mean, just think about it. Do you own a home? Do you have any savings? Do you have retirement accounts? Do you have life insurance? How about children or grandchildren that you deeply care about? If you answered yes to any of these questions, then estate planning is absolutely for you. It's not really about how much you have. It's really about what happens to what you do have after you pass. And legacy planning includes setting up beneficiaries, right? Creating wills and trusts. But it also means positioning your assets properly so that your family doesn't get overwhelmed by taxes and probate costs and the lengthy time of being in probate and the financial confusion during a difficult time. This is why I really love life insurance, because it is the asset class that many middle-class families have access to that is one of the most accessible, cost-effective, and powerful ways to handle this. I often tell life insurance agents that I know or that I meet that they are heroes, because when someone passes away and every other institution on the planet is sending that family bills and saying, you have to pay this debt, or you've got to buy this, or you've got to take care of the funeral costs, or you have to pay this bill, or whatever the case might be, the life insurance agent is the only person who is going out to that family, that broken family at that very difficult time, and handing them a tax-free check. I remember one of my clients many years ago was a real estate investor, and he had a couple of young kids and a wife. He was fairly newly married. He was fairly young as well. And we were talking about life insurance. And I said, look, you want to protect these kids? You want to protect your family? And he said, no. He said, I have quite a few real estate properties. And so whenever I pass, I'll just, those will just go to my wife. And I asked his wife about these properties. I said, do you currently manage these properties? And she said, no. And I said, do you want to? And she said, no. Of course, he may have never have heard that before, but it turned out that many of his homes were kind of slums. They were kind of on a very poor side of town. And his wife really had no business going over to this neighborhood and trying to fix up stuff when she had no clue what was going on. And she didn't want to. And that convinced him that he should probably go ahead and buy some life insurance so that down the road, if something were to happen to him, that she would receive a tax-free check to take care of any situation, to take care of the kids so that she could grieve properly and then figure out what to do with those rental properties. And she could actually sell them because she would have plenty of tax-free cash to rely upon. Well, once he had finally been convinced of the wisdom of that, he took the life insurance application and left. And I didn't hear from him for a couple of weeks. I tried to reach out to him, and it turned out that he had passed away in a car accident. And he had about half completed his life insurance application. This was a very, very difficult thing for me to process at the time, and I know it had to be incredibly difficult for his wife and for his children. Here was a guy who had finally decided that he was going to do something to protect his family, and then it was too late. I've had the same thing happen with individuals. I've said, hey, you really need to craft a will. You need to get those advanced healthcare directives down to the hospital so people know your healthcare wishes. But thinking about death is really unattractive, right? And we often have that Adonis complex, especially when we're younger. We think we'll just live forever. And we never think that the unexpected could happen to us. And so because people often think that estate planning is for the wealthy, they don't often even create a will. They don't often even create an advanced healthcare directive to actually let people know what their wishes are about their own bodies and their own health in the event of a tragedy. Friends, don't let that be you. Many people are turned off also by the fact that estate planning sounds expensive. And while it's true that it could be, it's not really that expensive just to simply set up a will, right? Or to get some advanced healthcare directives or to buy some term insurance, right? Particularly convertible term, which gives you the option to later convert to a permanent policy without needing to prove your insurability again. And remember, your health today is not guaranteed tomorrow. So locking in that option while you're healthy can be a gift to your future self and your family. I was convinced early on that I needed to lock in my life insurance insurability. And so I got as much term as I possibly could, and it was convertible, so that I knew that at any point in the future, no matter what happened to my health from this point forward, I still had the right to be able to convert that term insurance to a permanent type of insurance without needing to prove my insurability again. So friends, let's just shatter this myth once and for all. Estate and legacy planning are for everyone, not the rich. Protecting your family and ensuring your assets are properly passed on and giving yourself peace of mind, that's priceless. So don't let this lie prevent you from doing right by the people that you love and who depend upon you. Remember, if you fail to plan for the inevitable, it's going to create a massive emotional impact upon your family right when they're grieving. It could lead them to trying to guess your intentions if you're hooked up on life support, or it could lead to fighting complicated and needless probate battles when you could have simply just made a few key decisions that were very inexpensive to make. Proper planning removes the guesswork for your loved ones, and it provides clarity when it's needed the most. So the truth here is simple. Your legacy matters no matter what your net worth is. So make sure it's the legacy that you want to leave. All right, friends. Well, coming up, I'll share some concluding thoughts, and we'll wrap up today's discussion. Stick around. I'm Jerry Robinson. We'll be right back. All right, friends. Well, we've covered a lot of ground today. We've unpacked 4 of the biggest financial lies that hold so many Americans back, financially speaking. By way of a quick recap, we've exposed the myth of relying solely on one income stream. We've tackled the half-truth beyond buy term and invest the difference. We've examined the dangers of trusting historical market returns alone to carry you through retirement. And we have strongly challenged the idea that legacy and estate planning is only for the wealthy. Now, the purpose for uncovering these lies is not to shame anybody. It's not to cast blame. I mean, this is April and it's Financial Literacy Month, right? We're here to empower you with clarity. We want to move you from misinformation to real actionable wisdom. This episode is about opening your eyes to the realities of financial life and equipping you with the truth that leads to real security and real financial freedom. And as we close today, I want to leave you with a final word, as always, 2 powerful quotes, in fact, that speak directly to the heart of our discussion. The first comes from President James A. Garfield, who famously said, "The truth will set you free, but first, it will make you miserable." And closely related is a quote from the environmentalist and author Edward Abbey, who wrote, "Better a cruel truth than a comfortable delusion." Now, both of these quotes hit on the same profound reality. That is, truth, and especially financial truth, can be uncomfortable, even painful. After all, nobody enjoys realizing they've bought into a financial myth that's held them back, especially if it's held them back for years. But facing the facts about how we manage our money and how we plan for our future, or how we have underestimated certain risks, can be humbling and it can sting. But friends, here's the good news. That momentary discomfort that we feel when confronting these truths is the very thing that frees us from long-term suffering. As Abbey said, it's far better to wrestle with an uncomfortable reality now than to remain trapped in a comfortable delusion that quietly erodes your future. The truth is going to sting, but it also heals. It clears the fog, it opens new possibilities, and points the way forward. So today I encourage you, embrace the temporary misery of discovering financial truths, because on the other side is genuine freedom, true security, and lasting peace of mind. If you're interested in tapping into our brain trust, talking to our many financial advisors that we have around the country, if you just want to get our advice, maybe a second opinion on what you're currently doing, simply go to followthemoney.com/advice. You can complete the free online form right there, and we'll have somebody get in touch with you very shortly. You can also just simply email us by going to our website, followthemoney.com/contact, and just drop us a note and let us know what you're looking for. We'll do our best to connect you with someone in our network that can help. And as always, thank you for joining me on today's episode. Be sure to visit followthemoney.com for more practical insights. We got strategies, we got guidance there to help you navigate your financial journey. And if this episode resonated with you, please share it with someone who needs to hear this message, especially in this month of April, which is Financial Literacy Month. And remember, when you're ready for the truth about money, investing, and building true financial freedom, just follow the money. Have a safe and prosperous week, friends, and I'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussion on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.